All right. Good morning, everyone. Thank you for joining me this morning. Um, I don't know exactly how long it's going to take, but I'm going to try to cover a couple of very important topics in chapter one. Okay, so let me share this document with you. Okay. Okay, here. Okay, go to window and share this document. Okay. Okay, by now, you should be able to see the document that I'm sharing with you. And during the first class meeting, uh, we talked about the contra revenue. Contra revenue means revenue or money that never comes in, or money that may come in but turned right around and goes back to where it came from. And we call that contra revenue. And the first example we talked about in class was a discount. So that means when you offer a discount, that portion of what discounted the price would never come into your pocket. Okay, so contra revenue discount is, or rebate is an example of contra revenue, and we talked about a 110 net 30 discount. And the second example is returns. If you give credit for any unsold goods, any returned units, then at the beginning, you receive the money for all the units that you sold. But later, when the buyer returns unsold units, then you have to give the money back to the buyer for those returned units. So money initially came in, the money arrived, but later the money goes out to the buyer. So that is also another example of contra revenue. So in this example, so you initially sold 1,000 copies of newspaper, and you charged the $2. So what does that mean? That means, okay, let me see here. Go to draw here. Okay. All right. So here, so initially, so you the price was $2, and then you sold 1,000 copies, so you received $2,000. But later, the unsold copies, 50 copies, okay, when they are returned, you have to give the money back, and so $2 times 50 copies, that's $100. So this much money is what going out. So you only keep the money what $1,900. Okay. So what's the effective unit price after the returns of unsold units? Well, the what newspaper probably what if you are times per and then you may not actually want to the get those what unsold copies, okay, because it's useless. Okay, so if you say, all right, it's okay, you just keep those unsold copies, and but we're gonna still give you what the credit for unsold copies, $100. Then effectively, it's like it's like what you gave the Hudson News 1,000 copies of a newspaper, okay, and but you already gave what $100 back, so you only keep the what $1,900, okay, and but you initially gave the Hudson News 1,000 copies or so on. The effective price is it's like what? It's like $1.90, okay, because uh, the you basically gave the Hudson News 1,000 copies, but you only received what? You only get to keep what? Only $1,900. Okay, but that's not really important. All you need to understand here is what? Just like a price discount and rebate, returns. Whenever you issue credit back for unsold units, that is another example of what? Contra revenue. And the last example of a contra revenue is allowances. Okay, and sometimes sellers, the retailers will have to take the products out of the box and display them. So they are no longer brand new products. So, and the retailer will have to pick up such losses. And so to give them the manufacturers to give that they want to give the retailers enough incentive so the retailers will display their products to boost the sales. So they give what we call display allowances. Or when the products, the quality of the products is inherently deteriorating over time, okay? And then the retailers may not want to buy a large volume of a product, at once. So manufacturers will give retailers some incentives. It's okay. So when it's a value falls over time, so what? We're gonna issue credit for that. That is called spoilage allowances. Okay. So here again, a simple example: the wholesaler sold 1,000 units of a good for a unit price of 50 at the allowance rate of 5%. So if there was no allowance, then what? When you sell 1,000 units for a price of 50, then total revenue will be price $50 times 1,000 units. So it'll be $50,000. But it comes with an allowance rate of 5%. Okay, whether it's display allowances or spoilage allowances. So if the manufacturer or wholesaler issues the allowances, okay, 5%. So that means 5% of $50,000. So what is it? That will be 200. 10% means what? $5,000. Okay, 10% of $50,000 is $5,000, and half of it is what? $2,500. Okay, so allowance, the amount of allowance will be $2,500. So the actual money, the real sales revenue, the wholesaler gets to keep is 50,000 minus $2,500. So that will be $47,500. Okay, so that is what the net revenue. After allowances, the wholesaler only keeps the what? $47,500. So what's the effective price? Well, you sold 1,000 units, but actual money received is what? $47,500. And you divide this by the number of units you sold. So that means it'll be $47.50. So after allowance, effective price is per unit is $47.50. Okay, so I'm not going to ask you to figure all this out, but I just want you to know what the contra revenue is about and what are the examples of the contra revenue. So price discount or rebate, and the return, the credit for return the goods, and spoilage or display allowances. Okay. Now, the first main topic of today is the distinction between the accounting cost and the opportunity cost. You learned about these, the accounting cost concept and the opportunity cost concept when you took a while ago the principles of a microeconomics course, Econ 2020. Okay. Well, you may not have some the happy memories of that learning experience. Okay, so today we're going to start from scratch, and I will try my best to help you understand, to grab the full the complete the understanding concept of what these two cost concepts and the difference between them. Okay, think about this. So you and your friends, okay, are talking about, having a nice trip during the spring break. Okay. So, well, you thought about it and you figured out all the expenses that you might have to incur for the trip. So, if you decide not to join the trip because it was too expensive, it was out of your budget, over your budget. So, that means what typically we say, well, the way you count or the way you compute the expenses is what? It's accounting cost. Okay. You include what? Actual money you're going to have to spend on a lot of things. But you may also choose not to join the trip because not only what the because of all those what expenses that you may have to incur, but also you are worried about your schoolwork, or you don't want to give up your work. It would be nice to have what a week-long trip, but that means not only do you spend money on airfare, lodging, food, a lot of things, but you also have to miss out on your work. So if you have to what give up working for a week, that means no matter how much money you are making per hour, you have to give up on money making opportunity. So you have to give up certain amount of what your weekly income. So in that case, now what? Not only do you include money you're going to have to spend for the trip, but also you consider what you have to give up to join the trip. You see the difference? That's exactly what the difference between accounting cost and opportunity cost, or sometimes we call opportunity cost what economic cost. So clear definition here. What is an accounting cost, and when do we incur an accounting cost? Accounting costs must involve or must include entail actual cash outflow. Okay, so you actually have to swipe a card, write a check, or hand over a certain amount of cash to someone else in return for what you get some product or service or whatever. So if you do not actually spend the money, if you do not incur the monetary outlay, then you are not incurring accounting costs. So accounting costs must entail actual cash outflow out of your pocket or out of your bank account. Okay. But there's only one exception. There's one exception. It is still accounting cost, but it does not entail actual, cash expense. That the only exception is what we call accounting depreciation, or sometimes we call that depreciation allowances. If you are running a small business, you hire people, you pay for utility bills, and you buy a lot of raw materials, you buy insurance, okay? And for all those bills and the services or the materials that you use, you actually make a payments for them. So money goes out to the suppliers. So they are accounting costs. But if you purchased what expensive equipment, let's say a commercial truck for delivery purpose, okay, what your CPA does is over the machine life of your truck, each year, your CPA accountant will take a certain portion of its value, okay, count it as what? Business expense. So, well, you already purchased the truck and then you paid for it when you purchased it. But let's say the truck is lasting for 10 years, okay, and then you paid, let's say, $100,000 for the truck. Then, following the rules, set forth by the tax laws or IRS, the CPA will what? Write off certain amount as a business expense. So let's say, okay, we assume that your truck will lose what? 10% of its value each and every year. Okay. So over 10 years, but truck still is what? In good condition, but your CPA will say, well, we assumed your truck has lost what? 10% of its value every year. So at the end of what? 10 years, the truck has what? $0 value in the book. Okay. So that's what we call the depreciation allowance. Okay. But other than that, unless you actually what? Spend the money, you are not incurring accounting cost. Okay. Then opportunity cost. Now try to remember the example that I used a minute ago. When you give up, when you choose not to join the trip during the spring break, well, you had what? Two concerns. The first one was actual expenses. Okay. Airfare, food, lodging, and all other things. And then your second concern was while you are away, enjoying the spring break trip, you're going to have to miss out on work. So you cannot work for a week. So that means that you have to give up your weekly income. Now you consider that also what? As a cost that you have to bear. Now that is what? Broader cost concept. That cost concept is broader than accounting cost. And we call that opportunity cost. So here, its definition is not as straightforward as what? That of accounting cost. But here, the opportunity cost of one option. So opportunity cost is usually what typically used by what? Cost concept used by decision maker. So opportunity cost of one option or your choice, your action. For example, what's the opportunity cost of the going on a spring break trip? Okay, your action, your choice is the profit or benefit lost from the next best alternative. Okay, so what it means is, so opportunity cost is what? It's the encompassing all cost concept. So here, opportunity cost of what? Going on the spring break trip is what? The trip expenses. Okay, that includes food, the airfare, or the car fuel or whatever, and plus the profit or benefit lost from the next best alternative. So what would you do? What would you do if you did not join the spring break trip? Then you want to work, earning your weekly income. Okay, if we assume that that was what the next best alternative you have, okay, if that is the case, then now the the foregone income in case you join the trip, not only what all the cash expenses that you have to incur for the trip, plus what what other things do you have to give up? You have to give up your weekly income. So if you join the trip, that income will you have to forego that weekly income. So foregone income because you cannot work while you are joining the trip. Okay, so it is a broader cost concept. So then don't ever think one cost concept is superior to the other. No, there's no such thing. For all the practical purposes, profit loss statement or tax purposes, we use accounting cost concept. Okay. Now, for opportunity cost, then who's going to use this opportunity cost concept? Decision maker. Okay. If you are top decision maker of a business organization, then now what? You always have to think about the true cost of what? Your action. Okay. So let me give you another quick example. If you are the CEO of Delta Airline, okay. Now you have a large fleet of what? The passenger jets. Let's say one particular airplane is what, 20 years old. Now, the plane is still in good condition, so what? You can fly that airplane for another year. But is that the only option you have? So when you decide, okay, 20 years old, it's okay. If it's still what, in good flyable condition, then what? We're gonna use it. Okay, then that airplane will generate to a certain amount of income over a year. But if you are a wise decision maker, then what? You have to always evaluate your decision. So if I'm going to let this airplane fly for another year, is this the best option I have? Am I really exercising the best option? Then what other options do I have? Well, if I decide not to fly this airplane, then what? I may sell this what airplane to a discount airline company, or I may rent it out to another a discount company for a certain amount of income. And instead of what, you may purchase a more fuel efficient new passenger jet. So that's what where opportunity cost the concept plays very, very important role. Okay, so whenever you are about to make a decision, you have to use what opportunity cost the concept. By using opportunity cost the concept, you can evaluate the value of what the decision you are about to make by comparing it with all other what alternatives. So is it still justified? Is it still generating more income than the next best alternative that I chose not to pursue? So that's opportunity cost concept. So, but still, you may find my discussion a little vague. So we're going to use what more concrete, the number-oriented examples today. Okay. So here, uh, the very basic, simple question, just for warming up. You are currently using a web press to print newspaper. So you are using a web press machine, and you just use it to print the newspaper. Then the only option for the web press, the other alternative is what? Printing a magazine with a profit of $2,000. So we don't know how much money profit you are making by using web press machine to print newspaper. That's not important. Okay, and actually to print a newspaper, how much does it cost? Well, whatever it is, the cost is the opportunity cost of using the web press, okay, for newspaper, okay, is, okay, well, you, to print the newspaper, you have to use what, ink and paper or whatever. So we don't have that information. So this is what, so some cost of what, like a paper or ink or whatever, okay? So if you only include this, then what? You are using accounting cost concept, of course, which is not given here. But the opportunity cost, so what other option do we give up? Well, we could have used web press machine to print a magazine. And if we use the machine to print magazine, then what? We can expect a profit of what? $2,000. So this is what? The profit you expect from printing the magazines. Okay, so if you decide to continue to use the web press to print newspaper, that means now what other income do you give up? You could have made what, $2,000. You could make what, $2,000 by using web press machine to print the magazine. So that's what you give up. Okay, so since this amount, the accounting cost is not given, so we ignore it. Then what's the opportunity cost of using the web press for newspaper? In other words, here, what's the profit or benefit you suffer by not pursuing your next best alternative. That is what, in this example, that's what, using web press machine for to print magazines, that is what, $2,000. Okay. All right. So now here we're gonna discuss more realistic examples. Okay. So first, cost of inventory. Okay. Almost all retailers, wholesalers carry certain amount of inventory of their products. So it is not free. Okay. Think of what, a local business. You walk into a local store, you see a lot of inventory. Okay. And it's not free. Those retailers have already paid for the inventory. So their money is just sitting on the shelf. And those products are waiting, sitting on the shelf and waiting to be sold. So until those products are sold, then what happens? It incurs the what? The cost, because the store owners have already paid for them. But until those products are sold, the store owner is not getting any money back. Okay. Then why do they carry inventory? Because it is very important to prevent what we call stock out. Customers are stopping by and they are looking for certain products, and unfortunately, the products the customer was looking for what has been sold out. Okay, it's not a pleasant experience. But if a customers experience stock out more often, then probably what? They may permanently switch to another store, and then you may lose what? A good portion of your business. So that's why, even though carrying inventory is what, costly, most businesses will carry inventory to prevent what, unnecessary stock out, to protect their business. So carrying inventory is costly, but preventing stock out is also what, it is a what, it's a the, the beneficial. So you compare cost and benefit. So you decide how much inventory you're going to carry. Okay. So then how do we actually compute the cost of inventory? So here we're going to use a very specific example. Okay. So first, how do we calculate the cost of inventory in practical life? So how do you compute the accounting cost of inventory? Okay. Accounting cost. So there are the common ways, three common ways to figure out accounting cost of inventory. The first one is LIFO, the second one is FIFO, and the last one is weighted average. So let me tell you this. This is what IRS approved, government approved, man-made formula. Okay, so what it means is what we just agreed to compute the accounting cost what using one of the following approved what the methods. Okay, so it doesn't necessarily mean we are 100%, 100% accurate cost of inventory. Okay, so how do we do this? So first, let's use this example. A jewelry store purchased 1,000 ounces of gold, $1,300 per ounce. Later, the store purchased 2,000 ounces of gold. At this time, price was $1,400. Matter of fact, well, let me tell you this. So I needed to update this example because today, the gold price is almost $5,000 per ounce. Okay. But I purchased a certain amount of gold years ago, then I would have made a great deal of a profit. Okay. So anyway, if 100 ounces of gold are used out of the gold inventory, what's the cost of the gold per ounce? Okay. So here, so you purchase the gold at the two different points in time. So first time, 1,000 ounces, and the price was $1,300 per ounce. And second time, you bought 2,000 ounces for gold, and this time price went up a little bit, so you had to pay $1,400 per ounce. Okay, so now the same gold, 99.99% pure gold. Okay, so when you grab a bar, gold bar, and well, you want to make produce some the rings, necklaces, or whatever, you grab a gold bar. Well, unless you label them, you don't know which gold bar you are using. Is it the one of the gold bars that I purchased earlier or later? Okay, so in this case, you just use one of these three approved methods. Or if you are running an oil company, okay, think of an oil tank here. Okay, huge tank here, and so it is filled up with the crude oil. Okay, some crude oil, yes, you purchased it paying, let's say, $80 per barrel. Some, well, oil price went up, you had to pay $100 per barrel, or some, let's say, $90, whatever. And they are all mixed up. So when you take some crude oil out to refine it, what's the price you paid for the crude oil? Okay, it's hard to tell. So that's in real life, we use one of these three methods. First, LIFO, last in, first out. So we assume that we are using the gold we purchased most recently. Okay, and that is what, so last in. The gold that was purchased what last time, most recently, and that's what we are using first out. So here we bought gold at two different points in time. Earlier we paid $1,300 an ounce per ounce. Second time, $1,400 per ounce. So if you follow LIFO, then now what? We assume that you are using the last ounce of gold added to the inventory. So you paid what? $1,400. So accounting cost of using gold here based upon the LIFO method is what? $1,400 per ounce. Or if you use a FIFO, that means now first in, first out. So we assume that you are using the gold that you purchased the first time initially. And how much did you pay for it? You paid $1,300. So if you follow this method, then what? We assume that the accounting cost of the gold you are using is what? $1,300 per ounce. Okay. Now, if the gold price is not changing dramatically, then what? There wouldn't be much difference between the two methods. Whether you use a LIFO or FIFO, the price difference may not be large. But like these days, if the prices are changing dramatically over a short amount of time, then now what? Depending on which method you use, your accounting cost could be what? Overstated or understated. And then you can use what? Strategically, okay, to control the cost of accounting cost, okay. But we don't want to have an in-depth discussion here. So at least I just want you to know how in real life we compute the accounting cost of inventory. First one was the LIFO, second one, FIFO. Now, third one is what? Weighted average. Well, you do know you pay the two different prices for gold. So if you just either use $1,300 as accounting cost or $1,400 as an accounting cost, then what you do know, neither price is what? Accurate. So to mitigate this problem, we use what? Weighted average valuation. So one way to do so is here. So since we purchased two different quantities for two different prices, So we use the quantity, okay, and the price as what? Weight. So here, at this moment, how much gold do you have? How much gold inventory do you have? You purchased the 1,000 ounces first time, and then you purchased the 2,000 ounces second time. So a total of 3,000 ounces of gold. Okay, that's you have. So like this, out of 3,000 ounces of gold, we purchased what? 1,000 ounces gold first, and we paid $1,300 per ounce. So here you see here, out of a total inventory, 3,000, we purchased what? 1,000 ounces at this price. So we used this what? Quantity of gold we bought the first time, we use it as weight. So this price is weighted by this. And then out of 3,000 ounces of gold, we purchased the 2,000 ounces of gold later. And by this time, we paid what? $1,400 per ounce. So if you calculate it, so the same denominator, okay. So 1,000 times $1,300 and 2,000 ounces times $1,400. So if you use the calculator, okay, uh, plus and divided by 3,000. So it'll be about $1,366.67, just like that. Okay, so this is what a better measure of what the accounting cost of inventory. Okay, so there are three ways. Okay, so now if you are a jewelry shop owner, okay, so when you decide, okay, I'm gonna use a certain amount of gold to produce to make rings or necklaces or whatever. So then what? Before you decide how much you're gonna charge for the rings and necklace, then what? You need to understand the true cost of the gold you are about to use. Okay, because if you know the true cost of the gold, then now what? You will set the prices for rings and necklaces accordingly. Okay. So now, what did I say just a moment ago? Today's gold price is what? Almost $5,000. Okay. So today's gold price is $5,000 per ounce. So what are you going to do? Okay, one manager could say, well, I know today the gold is just selling for $5,000 per ounce, but I have a certain amount of a gold inventory, and I paid for some. I paid what? $1,300 per ounce. For the rest, I paid only $1,400. So I'm gonna set the price for gold rings and necklaces much lower because I paid a much lower price in the past. Is this the best decision a manager could make? Not really. Okay. So how do you figure out the true cost of the gold you are about to use? Let me use this example. Okay, you are planning to use some gold to produce gold rings and necklaces today. But unfortunately, last night, robbers broke into your store and stole all your gold inventory. Okay, so you have no gold right now. So, but to run your business, you have to buy gold again so you can make a gold rings and necklaces or whatever so you can sell them. So now to restock your gold inventory, now what price do you have to pay? Today's gold the price in the market is what? $5,000 per ounce. So what does that mean? Regardless of what price you paid for gold in the past, the true cost of gold, the true value of gold is what? It's a market value today. Okay. So if you are truly wise manager, then now what? Regardless of what price you paid for gold in the past, when you are about to use gold today, then what? Each ounce of gold has what? A market value of $5,000. So you will set the price for gold rings and necklaces what? Accordingly. Okay. So it has no formula, opportunity cost of inventory, whether it is a gold or any other product. The true cost, opportunity cost of using inventory is what? It's a market value today. Okay. So on the test, if I say today's gold price is $5,000 per ounce, then what? Regardless of what price you paid for gold in the past, the opportunity cost of using gold inventory today is what? Today's market value, $5,000. Okay. All right. Okay. Now, this is a most challenging example, I would say. And so this time, we're going to also compare accounting cost and opportunity cost of using a capital asset. Okay, so here, now you have to make a distinction between capital asset and the physical asset. Okay, so here, physical asset. But actually, this is the same thing. Okay, physical, the capital asset. Okay, and then the distinction we want to make against this is financial capital. Okay. In ordinary conversation, when we use the term capital, we often refer to financial capital. Financial means money, okay, or money you keep in what? Bank, the CD account, or the money you invested in what? Stock market, or U.S. Treasury, the securities, whatever. But in economics, sometimes we make a clear distinction, but sometimes we don't. But if we just say capital asset or physical capital, what we are referring to is what? Equipment, machines, okay, with what? The multiple years of what? Machine life. Okay, so it's not like consumables. It's not like a toilet paper. Okay, you purchased what? Commercial truck for delivery purpose. You purchased a wet press machine. Okay, or you purchased what? Any other equipment or expensive machines. They have what? Machine life. They last what? Over years of what? It's a machine life. That we call them physical capital asset or just a capital asset. So, for example, Delta Airline has a fleet of a passenger jets, and some airplanes are what 20 years old or 25 years old. Okay, so now you continue to fly them. If you continue to fly them, then you always have to evaluate. Okay, letting those airplanes fly for another year, is that the best option we have? Is this the best option we can exercise? If we stop flying them, what can we do with those the airplanes? So capital asset here. An airplane is an example of a capital asset here. Okay. So here again, I'm going to use the same example you find in the textbook. Okay. So the wet press machine is very expensive. The wet press machine you've been using was purchased at the $20 million with a machine life of 10 years. Okay. So here purchased at the $20 million, but this is what? The initial price you paid. Okay, sometimes we call this what? Historical cost. Okay, that means what? Total price you paid for something, and then you should be able to generate what? Receipt, proof of a purchase. Okay, your CPA, before your CPA writes off certain expenses, your CPA will always ask for the proof of a purchase. Did you actually spend this much money? So here, yes, you spent $20 million for this web press machine. Next, machine life of 10 years. We really know how long this web press machine will last? Of course not. It depending on how do the maintenance work. Okay, or depending on who is using, how the web press machine, its machine life will vary. But if you look at U.S. tax code, okay, then typically what you are allowed to choose what any time, okay, like typically what up to 15 years. So you can do what the assume that the web press machine will what have only what relatively short machine life, like 5 years, or if you want, you can say what this machine will last for 15 years. Okay, so it's all depending on what. So how you spread the cost of what the web press machine over time. So if you want to spread it over longer time period, and if you want to what write off the relatively small amount each year as a business expense, you choose what longer machine life. Okay, but if you want to what uh, expedite, accelerate the depreciation, and so if you want to spread the cost of what machine over a relatively short amount of time, then you pick what relatively short machine life. Okay, it's up to you. But here we assume that you picked what 10 years of what machine life. So you are wondering the annual cost of what using the web press. So now, well, you can use this machine within machine life, okay, but you want to evaluate each year. Is it the best option, okay, to use this web press machine for another year, okay? Or if I stop using this web press machine for another year, and then what other option do you have, okay? So we're going to compare accounting cost and opportunity cost. So here, to make the story a little more realistic, so we added what additional pieces of information. So if you stop using the web press machine for another year, then what other options do you have? So here we assume that you have two options. First option is you can rent it out for $3.6 million a year. Okay. For example, it's more efficient, more advanced web press machine is available than what? Okay, we're going to stop using old one and we're going to rent it out, and instead we're going to buy new one. Okay, so if in case you rent it out, how much the rental income can you generate? Well, in the market for used web press machines, similar web press machine is currently what rented out for $3.6 million a year. And the second option you have here is well, instead of renting it out, you may just want to get rid of it. You're going to sell it to someone else. Well, the similar web press machine can be actually sold for what $18 million in today's market. Okay, then what you sell it, and then you can use that money. You're not going to sit on that money, so you can keep the money in any interest-bearing account, or you can make what more put the money in what some other investment opportunities. Okay, so here your second option is what sell it and then use the money for the return out of an investment. Okay, and then you think the most profitable investment opportunity you have is what about expecting what a return of 12%. Okay, now that's one. Accounting cost may be the same for everybody, but opportunity cost may not be the same depending on who you are. Okay, right. Suppose I am given $18 million. Okay, how much return can I generate out of $18 million? Okay, if I don't have enough financial investment skills and knowledge, then what? I may not be able to generate the 12% return. Okay, but if you are well experienced, then you might be. Okay? So opportunity cost is what different depending on who you are. Okay, obviously the opportunity cost of what using 1 hour of my time. Okay, so what can I do out of 1 hour of my time? But if you ask the money value of what 1 hour, okay, the if you ask like a Michael Jordan or someone else, okay, then for that person, the dollar value of 1 hour could be what, way different than mine. So here, anyway, we assume that you can generate a return of 12%. And if you use the web press for another year, okay, well, if you decided to use this web press machine for one more year, then now what? Its market value will drop by $3 million a year. So what it means is if you sell it this year, right now, today's market price is $18 million. But if you use it for one more year and sell it this time next year, then now what? Your web press machine is what? A year older. So then market price, for example, similar idea what? Let's say your web press machine right now is 3 years old. And well, it can fetch $18 million. But in the same market, 4-year-old web press machines are typically what? Selling for $15 million. So a year later. So if you sell it this year, you can get $18 million, but next year, $15 million. So that means what? The market value of your web press machine will drop by $3 million a year. Okay. So what happened to the market value over a year? We call this what? Economic depreciation. Okay. Economic depreciation. So you have to tell the difference between economic depreciation and the accounting depreciation. Accounting depreciation is what? It's a IRS approved what? Man-made what? Kind of bogus rule. But economic depreciation means what? The market value of something is what? Changing over time. What as a product gets older and older, then what? Its market value will drop. How much money do you expect to get if you sell your car today? Okay, well, I have to graduate, so what? I need a car to commute. So what? I'm gonna drive this car for one more year, then I'm gonna sell it. So if I sell this car next year, then what? Probably the price you can possibly ask for will be a little lower. So over 1 year time period, the market value of your car is falling. That difference is what called the economic depreciation. Okay. So first, in this case, how would your CPA will calculate the accounting cost of using capital asset? So here, it's very simple. We're going to use a straight line depreciation. Okay. This is the simplest form of what? Accounting depreciation. Straight line depreciation. So what it means is we assume the value of web press machine will fall by an equal amount each and every year. Okay. So here we assume the what? The web press machine has a machine life of 10 years. So that means we are assuming that the market value of this web press machine will what? Fall by a certain amount, fixed amount each and every year over 10 years. So at the end of 10 years, it'll have no value. That's what we assume. Okay. Web press machine may still have some market value even after 10 years passed, but just what? In compliance with the tax code, the tax rules, If you pick 10 years of a machine life, then now what? In the book, after 10 years, web press machine will have what? $0 value. So here, how do we use this straight line depreciation to figure out the accounting cost of using capital asset? It's straightforward. Always what? Historical cost divided by machine life. So in this example, what's the historical cost? Initial price you paid for the web press machine, which one was $20 million. And here we use a straight line depreciation, and we assumed the web press machine has a 10 years of a machine life. So we divided this by 10 years. So then it's what? $2 million per year. That's it. So just we assume that each year your web press machine will lose its value by $2 million a year. And so after 10 years, it has no value. But in real market, it could still have some value, but for tax purpose, its book value is a zero. Okay. So that's how your CPA would calculate the accounting cost of what? Web press machine or your commercial truck. Okay, it's very simple. If when we use a straight line depreciation, you just divide the historical cost by number of the machine life years. Okay. Now, opportunity cost. So if you are a decision maker, okay, you really want to know the true cost of using this web press machine for another year. Okay, not based upon man-made IRS approved bogus rule. Okay, because you really want to know the true value. So here, how did we define opportunity cost? It was profit or benefit you're going to lose by not pursuing your next best alternative. So here we said, if you use this web press machine for one more year, what other options do you forego? First one option was renting it out. Second option was selling it and then invest that money. So we're going to evaluate the dollar value of each option. So first, rent it out. Okay. If you rent it out, then what? You receive a rental income of $3.6 million. But you have to be very careful. While you are earning a rental income of $3.6 million, when you leave your web press machine in someone else's hands for a year, and then you receive $3.6 million. But after 1 year, by the time you get your machine back, is this the same machine? No, the web press is a year older. So what did we assume here? If we go back, we recognized here what? Okay. Here, economic depreciation. You leave it in someone else's hands for a year. Okay, then by the time you get your machine back, your machine no longer has the same market value because its market value is falling. Here we assumed that a year later, okay, its market value is falling by $3 million. Okay, so while you are earning $3.6 million of rental income, you are suffering an economic depreciation. So you suffer an economic depreciation of what? $3 million. Okay. Look, you are about to what? Rent out your something. And then your friend says, okay, hey, can I use it for a year? Okay. And then, well, by the time I get my, the asset back, will it have the same market value? No. So here, so your true net gain is now, while you are earning $3.6 million of rental income, its market value drops by 3 million. So your net gain here is only $600,000, $0.6 million. Okay. So second option, sell or selling it and invest. So, well, sell it for $18 million. Okay. And now invest $18 million. And here we assumed you can get a return of what, 12%. That's pretty high. So let's say, so how much return do you get? 12%. So $18 million times 12%. So you get $2.16 million. Okay. Okay. Now here, do you need to worry about economic depreciation? No, you already sold it. It's no longer yours. So you don't care about, whether, the price is falling dramatically or the machine value is is falling down over time. You don't have to worry about it. Okay. So now, so here we evaluated what two options you have. Okay. If you rent it out, you can get a rental income of $3.6 million. But by the time you get your machine back, its market value will be down by $3 million. So your true net gain is only $600,000. But if you sell and invest the money, and if you get the 12% return, then now what? You have a $2.16 million return. So now, if you continue to use this web press machine for another year, okay, can you beat whatever, how much money you may make? Can you, your current, when you continue to use the web press machine, can you beat this much profit you get from renting it out? Or can you beat this much investment return you can get when you sell the machine and invest the money? Okay, so you have to compare it. Okay, so relative to these two options, is using the machine for another year justified? Is it worthwhile to ignore these other two options? Now, between these two, if you go back to the opportunity cost concept, we said it is profit or benefit you have to give up by not pursuing your next best alternative. Between these two options, you forego. Which one is the best one, the better one? Well, one is net gain of $0.6 million. The other is a gain of $2.6 million. So this is much greater. So this is the next best alternative. Okay. So when you decide whether or not you're going to use this web press machine for another year, then what? Okay, if I use this web press machine for another year, no matter how much money I make, will I be able to make more money than this $2.6 million? So that's how you base your decision. Okay, so here, opportunity cost of using web press machine for one more year. Accounting cost, your CPA would say hey, $2 million. Okay. And then we can write off $2 million each year as a business expense. Okay. For the next 10 years. Okay. That's how they do it. Accounting cost of using capital asset. But as a decision maker, you evaluate each year. Okay. Will I be better off using this web press machine for another year, or should I pursue any other option? So in this case, at this moment, if you decided to use web press machine for one more year, the best option you give up is what? The second one. Sell the web press machine and invest the $18 million, yeah, what, for the return of 12%. That is what? $2.16 million. So here, opportunity cost is what? $2.16 million. So this is indeed one. This is the opportunity cost of using the web press for one more year. Okay. So out of this simple story, I can ask a lot of questions. Okay. Okay. Let's go back here. When I give you a simple story like this, okay. So I can say, what is your, if you use a straight line depreciation, what is your annual accounting depreciation? $20 million divided by 10 years, so $2 million a year, okay? And what is the amount of economic depreciation? Economic depreciation means what? How much does the market value drop over a year? Here, $3 million. And then I can ask a more specific question. What's the accounting cost of using this web press for another year? When you use a straight line depreciation, simply you divide the historical cost, $20 million, by its machine life years, 10 years. So $2 million per year. That's how your CPA would compute accounting cost of using what? Web press machine for a year. Now, as a decision maker, how would you compute the cost of opportunity cost of using a capital asset? So you compare two options. One, rent it out. Second, sell and invest. And between these two, the larger profit is what? The opportunity cost of using web press machine for another year. Okay. So, okay, we're gonna stop here. And on Wednesday, when we meet face to face, we're gonna discuss the rest of chapter 1. Okay. All right. I'm gonna stop sharing, and I'm gonna post this recording later on Canvas. So for those who missed this virtual meeting, they could catch up. Okay. And do you have any questions? Okay. If you have any question, you can raise your hand. Okay. Otherwise, thank you so much for joining me this morning, and I will see you again Wednesday. Stay safe and warm. Thank you.